Hi guys. Today we will analyze Keurig Dr. Pepper stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The long-term trend is still positive. The short-term trend is neutral. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $36.60 and $34. Next strong support levels are around $32.40 and $30. Resistance level is around $39.30. In the last month the stock has been trading between $36.60 and $38.50 range. The stock has an average volume of 5.8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 26% per year, for last 5 years. We see that the average profit margin of the stock has been around 20% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 149% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Keurig Dr. Pepper Company: bad, average, and good. First scenario. Keurig Dr. Pepper will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $19. Second scenario. Keurig Dr. Pepper will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 14%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $26. Third scenario. Keurig Dr. Pepper will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 16%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $35. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 1.51. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Keurig Dr. Pepper, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 22. Again, I will use 3 different scenarios for Keurig Dr. Pepper Company: bad, average, and good. First scenario. Keurig Dr. Pepper will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $11. Second scenario. Keurig Dr. Pepper will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future P/E would be average, 17. In this case, The fair value of the stock today would be $15. Third scenario. Keurig Dr. Pepper will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 19. In this case, the fair value of the stock today would be $21. As you can see, today the stock is overvalued, $37, even if we expect the company's high performance in future. While the company is still in line with the averages on profitability rating, there are some concerns on its financial health. While showing a small growth rate, the stock looks expensive at the moment. I may consider buying the stock when the stock drops below $30. Company strengths. Keurig Dr. Pepper is the third largest beverage company in North America in terms of total revenues. Formed with the merger of Keurig Green Mountain and Dr. Pepper Snapple Group in 2018, the company has leadership positions in soft drinks, specialty coffee and tea, water, juice and juice drinks and mixers, and markets the top-selling single-serve coffee brewing system in the U.S. The company's distribution system enables its portfolio of more than 125 owned, licensed and partner brands to be widely available. With a wide range of hot and cold, the company's key brands include Keurig, Dr. Pepper, Green Mountain Coffee Roasters, 7-Up, Canada Dry, Schweppes, Crush, Snapple, and other. The relatively stable nature of the company's end markets, and its strong cash flow generation ability. With a formidable distribution system, the company is able to gain exposure to secularly advantaged categories, through partnerships with upstart brands. The company has a profit margin of 17%. This is amongst the best returns in the industry. Its return on assets of 4% is comparable to the industry average. Risks. Risks include commodity and labor cost inflation, risks related to new products, and macroeconomic conditions. Outperformance of partner key pod brands, relative to proprietary brands could shift the axis of power against the company, during future contract negotiations. Geographic diversification should be limited, as the firm does not own the rights to many key trademarks outside North America. Other risks are environmental, social, and governance. The company is more exposed than peers, given its predominantly U.S. footprint, where health awareness is most pronounced. Additionally, the firm has not historically been the best environmental steward, particularly in its key pod business. The company's return on equity of 9% is worse than the rest of the industry. The industry average return on equity is 15%. The company is not financially healthy enough and could expect problems in meeting its short-term obligations. The company is expected to show a small growth in revenue and EPS. In the coming 5 years, the revenue will grow by only 4% yearly. The earnings per share will grow by 8% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.